Hello again. Good evening and welcome to FS Insight Hub. This is Pelibos. Today we are going to discuss a very interesting topic, right? This is the main reason many people feel like trading is a scam. At the end of the day, you realize that the problem is um, by ourselves, or we cause our problems ourselves and not the market. Okay. Risk management is essential. If you want to be a professional trader, then don't skip anything that we are going to say in this video. Try and apply them. What I'm going to say is it's difficult to follow them, and I'm just going to tell you what you should do. But the main thing is trading psychology, the mind battle. When you enter the trade, what you go through, that is the actual thing. So before you can master risk management, you must master self-control. You must master how to control your mind when you are in a trade. It's very important. And so trading, you need to be disciplined. You need to be a disciplined trader. That way, it will translate into a proper risk management. All right. So these are some practices that I feel or has been proven to, render one highly profitable over time. And so if you want to become a profitable trader, then this is something you don't want to joke with. Okay. So let's get straight into it. So what is risk management? Basically, risk management is the process of controlling potential losses. So no single trade can significantly damage your trading account. So the problem with many traders is that most of the time, when people blow their account, it is as a result of a single trade, or it is as a result of what a single day's trade. People don't blow their account over time. They blow it at once. What I mean is that they have, say, $1,000 in their account. Today they lose $20. Tomorrow they lose $50. Then all of a sudden, boom, everything is gone to zero. It means they lost everything in a single day. Okay. Yes. So risk management is the process of controlling potential losses. So we are going to control the losses. So we say potential losses because trading is risky. So it means that the moment you enter a trade, potentially you can lose the trade. Okay, you can lose the trade. So we are looking at how we can control the losses such that not or no one single trade can finish our account. This is very important. Okay, so we are going to learn this by managing potential losses through position sizing, the number of positions that we take, the lot sizes that we use, and then we will learn about using stop losses and becoming disciplined in a long term. Okay, once we're able to do this, then we can control the potential losses. We can control any visible losses. Okay, now the 1% rule. Ideally, we advise that you don't risk more than 1% of your account on a single trade. Now, there's a problem with this because many Africans, many people do not have money when it comes to trading, and that alone is a red flag. See, trading is a way you can make money, but if you don't have any source of income, if you don't have any money anywhere, it will be difficult for you to make money through trading because the reason is you need money to make money. You need money to be profitable. You need money so you can become what? Consistently profitable. That is the facts. Okay. We are not going to bend it. We are not going to shy away from it. We will say it as it is. You need money to make money. So mostly it is difficult for people who want to use trading as their sole source of income. The reason is there should be something backing you. Other than that, you'll be frustrated. And the moment you are frustrated, you are going to forego all the things we are going to mention in the video. And then you are going to blow your account. All right. So there should be backing somewhere. You should have something that you can fall on in case trading doesn't go well. Okay. So The 1% rule says that you don't have to risk more than 1% of your trade. Now, this one applies to every trader, or irrespective of your background. So I'm speaking to people of our caliber, people from Africa, those of us who also don't have money. I'm speaking to all of us. And this is why we find it difficult to become profitable. Because if you risk 1% of your account, if you have $1,000, 1% is what? $10. It means that every trade that you take, you are risking just $10. If you have $1,000 and you are risking $10 out of it, if you are to lose it, you are back to $990. If you lose again, that is $980. If you lose 10 times, that is $900. You get it? That means that it will take you 100 trials to eventually blow the account. And if you are going to lose 100 trades consistently, please pack your tools and leave. The market is not for you. Trading is not for you. Again, that's the harsh truth. Okay. There's no way you can lose 100 trades consistently unless you don't follow any rule, you don't have any strategy, you are just trading anyhow, right? Then this is a problem. So how do we solve it? Many of us are going to trade with $100. Many of us are going to trade with 200, some even less, $50, $20, what have you. You cannot apply this rule if you are being frank with ourselves. Because say you have $100 in your account, 1% of that is $1. Which trade are you going to take that you are going to risk $1? Which trade that you are going to risk $1? So it's not realistic. Good. So it means that you will be forced to increase your risk. That is what it means. So ideally, I say that whatever amount that you have, if it is below $500, divide it into 20. Divide it into 20 and risk one out of the 20 on the trade that you take. Okay, so if you have, say, $200, if you divide it into 20, that is what? $10 each. So every trade that you take, risk $10 on that. Okay, risk $10 on that, and it is going to help you. Okay, again, if you lose 20 trades consistently, you are not a good trader. Like, that's a fact you should face. You are not a good trader. Right. So this is how you are going to do it. So I'm stating it here again. The minimum that I would recommend that you trade with is $200. That is the minimum. That is the least. So if you are coming to me with anything less than that, know that I don't approve of it. Okay. And it's because of risk management rules. It's not that by force I'm saying go and bring to. No, if you really want to do this, you need to do it the right way so that you can make money. And we are teaching you the right way to go. Okay, so the minimum should be $200. And if you know me, since 2020, this is what I've been saying. The minimum is what? $200. You risk $10 per trade. It's gonna help you. Okay. Position size. Know that the lot size that you are going to use is dependent on your capital. The risk that you take, how much you are willing to risk, is dependent on your capital. This is what I've said before. The stop loss that you are going to place is dependent on your capital, and the pip value, which comes back to the lot size, is dependent on your capital. So if you see that I am trading with 5.0, 10.0, because sometimes I use crazy lot size, please don't be forced to do any of that because you don't know the capital I'm trading with. You do not know the capital I'm trading with. Don't copy me blindly. How do you do this? You have $200 in your account. We have said that raise $10 on the trade. Go to your chart, the MT5. If I'm to enter here, I'll put my stop loss here. How much am I going to raise? Nowadays, it's simple. The system will calculate it for you. So you can tell exactly how much you are risking. Okay. So even before you enter the trade, do this assessment, right? And know where to enter, where to put your stop loss so that it will give you the right risk that you want to take. Then when the market gets there, you can enter. So aside everything that we've learned about technical analysis and then all other blogs and what have you, These things are important because this is what is going to give you the money. These practices are the ones that are going to give you the money. Okay. So do that so that you can stick to the risk that you want to take. Right. So stop loss placement. We've said this. Every trade that you take, make sure you set a stop loss. So we have what we call trade assessment. Before you enter the trade, assess it. Know where to put the stop loss, where to put your take profit. So if you have covered the lesson up to this point, you know that you don't place your stop loss anyhow. I've shown you how to do it. The previous video, I mentioned that when you are using other blocks, you know where to place it. So when you go to the MT5 and you check, and the risk is more than what you want to risk, what you want to take. What it means is don't take that trade. There are opportunities in the market every now and then. You'll find a lot of them. So if the risk is too much, don't take the trade. I hope I'm clear. And this is danger. Do not move the stop loss further away to avoid the loss. This thing is dangerous. Those of you who have not started trading yet before coming across this video, you don't know what the Lord has done for you. Those of us who have traded before, you realize that the main problem is you can't wait for market to get to your TP. The moment market moves in your direction and it start dropping, you close the trade. But then when the market is going against you, when it's approaching your stop loss, what you try to do is that you move your stop loss further away so it doesn't take you out because you are still convinced the market will go in your direction. That's a dangerous practice. It is a dangerous practice. If you continue to do this, you will one day blow your account. You will keep on shifting it until boom, you receive a margin call, everything is gone. You get it. So stick to it. If it is $10, it is $10. If it clears you, that is fine. If you find another opportunity, you enter. If you don't, let it be. You understand? These are very important. If we cannot do this, we cannot be profitable. It is as simple as that. Risk to reward ratio. Now, I don't know if I've mentioned it before, but risk to reward ratio, we are talking about how much you want to risk and then how much you want to gather from the market. So we are saying the least you should have, the least you should take is what? 1:2. So you see, I've said if you are trading with $200, then your risk should be $10. If that is the case, it means your target should be $20. The least should be $20. Now, the reason is that your target should always be bigger than the risk so that if you have, say, two losses, just one we can cover all the losses. All right. Now, in some cases, we are fortunate enough to have about 1:4, 1:5, 1:10. It doesn't always happen, but sometimes you find them. But the bigger the risk reward, the harder the trade because you're not likely to hold the trade to the TP. That's a fact. You're not likely to hold it. So it's best you stay realistic. 1:3 is okay. 1:4 is okay. Okay, do that. And then it will help you. So if you are sticking to your risk to reward, let's say you have $200 in your account. You want to raise $10 per trade. Let's say you take 10 trades, and out of the 10 trades, you lose five and then you win five. What it means is you've lost 10 times five, that's $50. You've won 20 times five, that's $100. If you take your loss from the $100, you are left with what? $50. So now your capital is back to $250. You get a point. So you can even lose more and still because the reward is bigger than the risk, you will still be profitable in the end. So make sure you stick to the right risk to reward. And then again, many professional traders advise that you stick to the same risk to reward. It should be uniform. That is also going to help you. That will help you to become profitable in the long run. Because if you are using the same risk to reward, it means that if you lose, say, four times and you win four times, always the reward is going to cover the risk. Okay. But if it is not uniform, then you realize that you'll be losing eventually. So it best you stick to a uniform risk to reward ratio. Then you should have a maximum daily drawdown or a maximum daily loss. You must state to yourself that every single day that I trade, the maximum I'm risking is this percentage. The you know, in theory, we are saying that it should be between 2% to 3%. This will save you if you have the right capital, say $10,000, $100,000. What have you? You can stick to this. Okay, even when you have those big, crazy capital, you will break this further. You see that trading is now very easy. It's because you don't have money. That's why you're struggling. When you have capital, good capital, trading is very easy. Okay, right. So stick to it. So in your case, you can stick to a maximum of $20, $30 per day if you are starting with 200. Now, if you have 400, I want you to mirror the same thing. Okay, so 400, you'll be risking $20 per trade. That's what I'm trying to say. Yes, so what are we saying? So that if you have $200, you are risking between 20 to $30 per day, and it's enough. Don't go beyond $30 per day, okay? And you see it will help you. The advantage of this is that sometimes the market is just bad. So when you take one or two losses, you withdraw. I mean, you hold on, you go and come back another day because maybe the day is just bad. Okay, and then you are able to recover. But if you continue, you see you keep on losing before you know everything is gone. All right. That is why we advise you stick towards this maximum what do you call it? Daily loss. Okay, it's important. Correlation risk. Now this is what do you call it? Very common among forex traders. You see that we have correlated pairs. For example, Euro USD, GBP USD, AUD USD, right? All those, the ones that have USD at the end. It means they correlate most of the time. If one is in an uptrend, the others will also be an uptrend. If one is in a downtrend, the others will be in a downtrend. It means that if you have to take a trade on them, and then you take, let's say you are trading Euro USD, at the same time you're trading GBP USD, at the same time you're trading AUD USD. If the markets start going against you, all three of them will go against you because the markets are correlated. Okay. And so it means that in your case, if you have raised $10 on each, at the end of the day, you're going to lose $30. And that's just one trade for the day. Okay. So avoid that. Don't, in fact, I advise that don't trade multiple assets at the same time, especially if you're a beginner. Don't trade multiple assets at the same time. It is not going to help you. Avoid it at all cost. Okay. Stick to one trade at a time. Build your account steadily. Over time, when you get a good capital, you can start doing some of these things. But until then, avoid it. Now, trading psychology. This is a whole course on its own, which we are going to treat. But mainly, we are talking about what controlling your emotions. Avoid over trading. Avoiding over trading. If you stick to maximum daily loss, you will avoid over trading. Okay, you will avoid it. Avoid revenge trading. When you lose a trade, don't think that you are going to get it back. That way, you are revenging the market. Before you know, boom, everything is gone. Don't do this, okay? You can't take revenge on the market. It will kill you. So when you lose one or two trades, it's okay. Tell the market I'll come back again. Go and revise your strategy. Get why you lost the trade and come back again. Better. You can recover your losses. Right, so we are saying that as a trader, you should keep a trading journal. And in this journal, what you should do is record every entry, record every exit, record every risk, record the result, and record the lessons that you have learned from that trade. Record it. At the end of the week, go back to it, check it. Why did I lose? Why did I win this trade? Is it because I followed the strategy? Okay, then I'm going to follow it next time to see if it will work out. Why did I lose? I missed this and this and that. I'm going to work on it next time. Okay, keep a journal. It is going to help you. I'm saying it again. If it's your first time, like you've not taken any live trade, and you've come across this, you see, you don't know what the Lord has done for you. These things that we are mentioning are challenges that traders are facing. You know them beforehand. So it should be a different story for you. Okay. So that is that. I hope that you learn a few things here. So one thing I want you to remember is that always make it a priority to what protects your capital. Make it a priority to protect your capital. The market will always be there, but your capital will not if you joke with it. So you will see that there will be a very good opportunity, but because you rushed, your capital is gone. Then the market is there. People will now make money and it will pay you. Yes. To always protect your capital. Be consistent. Stick to the same risk to reward. Stick to the same lot size. It will help you. It will help you stick to the same risk throughout and then follow your trading plan. Trading plan, we are talking about the number of trades you want to take per day, the risk that you want to take per day, the maximum loss per day, your target, and then all that. Stick to the same thing. Okay, be consistent. That's the whole thing. Don't be taking random trades because you get random results. Then manage your risk on every trade. Every trade should have a stop loss. Very important. Every single trade you take should have a stop loss. Okay. So these things that I've told you, okay, they are practical. You need to apply them. You don't just read them. Okay. Apply them. I'm begging of you, apply them. You will be profitable. If you fail to do so, trust me, you end up saying trading is a scam. It is not. Okay. So yes, let's go back and then make sure we apply these things to our trading. And trust me, 3 months from now, you should be at a better position. You will thank me. Yes, so let's try and do that. And trust me, it's going to be well with us. Okay, so if you have any question, come back to me and then I'll be glad to explain. Thank you. See you in the next lecture.